Welcome back to Real Estate Mindset, you guys. And today's video is going to be absolutely bonkers. There's a lot going on in the market today, so we'll cover all of that stuff today. More movement with the 10-year. So some more news came out. We'll go over that. Like I said, we'll go over a few videos and just really get a good idea for what's happening right now in in the market as a whole, and then how that may affect the housing market. Now, obviously, you guys, right now feels an awful lot like stagflation. Now, the good thing that we're seeing right now is, again, when we have that good news or when the inflation's too high or it appears that the economy is running too hot right now, we're now seeing like punishment, right? We're seeing the Fed and the market do something about it. And the issue here that I have as far as, how things are playing out right now is I really feel like they should have held us where we were at last November. October to November of 2022. The problem is we didn't stay there. If we stay where we're at right now with the 10-year at 4%, actually over 4%, residential mortgage rates over 7%, some people getting 8%, I think that we're going to be okay. The thing is like this roller coaster ride of tightening and QE that's going on. So we're going to go over that stuff today, you guys, and wait until I show you the unemployment rate. You guys are going to freak out. That's probably why we have activity in the 10-year once again. But first, guys, before I get into the report, let me say good morning to everyone. You guys keep me going. I can't tell you how much it warms my heart. You guys, so many friends here, so many friends. Elijah, good morning to you, brother, from the very beginning. I appreciate you, Elijah. You have no idea. Alexander, Todd, this guy right here, Todd, this guy's from Africa. You guys know that he has been giving me so many reports that I have been using for like videos and lives, and he's from Africa. Todd, brother, thank you for helping Real Estate Mindset community. Thank you for helping me and all of us. I love you, man. Good morning as well. Dave, this dude right here. Let me tell you guys something about Dave. I need to interview Dave. I need to get Jeff on here. I need to get Melissa on here. Dave is currently in the process. Dave, I hope I could say this, but he's currently in the process of purchasing a home. And guess what, guys? It's a new build home. So I need to get him on our channel. We need to talk to this man just to make sure he's doing the necessary due diligence with the new home building, right? Inspection, right? Good morning to everyone. I mean, I just really appreciate you guys. Just happy Friday, Juliet. Juliet, just so nice to see you. So nice to see you, Kim. Vital, you already know I love you, Vital. And I hope I don't have to pay you $1, man. I really want your dollar so bad, Vital. So this is going into listen to what Vital's saying. So first of all, in my market, listings are up. Different markets. He's in a bad market, but his new listings hit a low. He hasn't seen in his market. I would ask though, Vital, is it lower than last year? Like for real, is it lower than last year? Like make sure it's not just your emotions, like where are you getting the data? But here's the important thing to understand. It's really hot right now in the housing market, and the Federal Reserve needs to do more tightening to get it under control. And in fact, they should have stayed, like I said, at that level of tightening because obviously the seasonal trends broke quantitative tightening. And also the QE, obviously, right? And I believe the excess savings. Good morning, JQ. Good morning, Christy. Always appreciate y'all so much, JQ. Good morning. Guys, I'm going to get started here. I just always want to say how much I appreciate you guys for joining me. Vovol, I think I said good morning. What's up, Izzy? I don't know if you guys watch UFC, but Izzy is one of my favorite fighters. Sheldon, appreciate you guys. Andrew, Paul, my man Sheldon. There's Steve-O. There's my man Steve-O. I'm sorry I woke you up, man. I'm sorry. Go back to sleep. Go back to sleep, man. Go back to sleep. Nothing to see here. Nothing to see here. Good morning. Spencer, I like your first name. It's my last name. John, good morning. Wolf, I need to talk to you, Wolf. Okay, we need to talk to Wolf, y'all. Good morning, Jacqueline. Another Todd. We got a second Todd here. Wolf, I got a project for you. You guys, I'm going to get started here. If I didn't say good morning to you, I'm okay. Good morning, one-eyed WTH. John, my gosh, you guys are amazing. You guys are amazing people. Wolf, real quick, and then we're going to get started. Okay, Wolf is in the area of Phoenix. I have been really sounding the alarm on Phoenix, you guys, specifically because of the massive amount of new construction being built. Number two is the massive amounts of Airbnbs or STRs that are in Phoenix right now that I believe have no business being in Phoenix right now. So what I'm hoping you can do, Wolf, is I don't know how good you are with video or GoPros, or maybe you can go out to the Desert Oasis or Copper Canyon community out there, and he knows where this is at. And if you can, Wolf, take some videos, because you guys, the last time I was in Phoenix to do the boots on the ground, I found thousands, if not tens of thousands of homes in Phoenix. Okay, I think it was the northern part of Phoenix. Like I said, Copper Canyon, Desert Oasis. thousands and thousands of homes sitting empty. So I'm going to get back out there, Wolf. And if I go back out there, I'm going to try to get with you, man. And we're going to walk those communities together. I need someone boots on the ground because all these haters like, oh, Chavis, you lying, blah, blah, blah. So the more like we check this stuff out as a community, I believe it's going to be a lot more impactful. KOV in the house. I love this guy. KOV, it's nice to see you. Jacqueline, nice to see you. So we're going to get started here, you guys. Nikki, nice to see you. Everyone, just so nice to see you. Good. Appreciate you, Wolf. We're going to get started, you guys. This is very important stuff going on here. We're going to start with the 10-year. Let me go ahead and if I may move my camera over here. You guys, I feel like my hair is all puffy today. Also, y'all see what's going on right here? Okay, I'm just trying to remind everyone, okay? If there's historical precedence in us waiting right now, there's a historical precedence of caution right now. Historically, we should be cautious. 100% success rate on the indicators that I'm looking at. And I'm going to show you guys. So yesterday I brought up the 2 and the 10-year inversion, but today I'm going to bring up the 3-month and the 10-year inversion. And then we're going to really talk about like how far we may be from recession. Because remember, you guys, before we go into recession, they have to reinvert the bond, you guys, this is so insane. All of these victory laps being done. It's like the yield curve is not even uninverted yet. So we'll go over that. We'll look at the historical precedents. But first, let me show you guys the activity, if I may, on the 10-year. So we're going to start with the 10-year. Okay, this is our market update. We're at 6.35. I'm going to go a lot faster. I am sorry that I'm lagging, guys. But 10-year sitting at, it was a little bit higher. I wanted you guys to pay attention to this. It basically went in the positive territory like super early this morning. You guys see that right here? Went up. And then when the job numbers, so we're going to go over the job numbers. When the job numbers came out, as crazy as it sounds, and I was watching this live, the 10-year plummeted. Like it went down, I think, 2 basis points, maybe 3 basis points. You can see that. This was this morning, you guys. And then in a matter of minutes, it shot back up. So very, very interesting. And it peaked right about here, which was 4.09. It's now down, like I said, to 4.049. It's up 1 basis point. So there's a little bit of activity there. Now, the reason for that activity, at least initially, when I saw that drop here, is because I think, okay, let me show you guys. First of all, the job numbers came out, all right? And where I want to start now, we'll listen to some videos and we'll have some people break down the job numbers and what's happening. But first, what I want to talk about is the unemployment rate. And guys, how good was our news report yesterday? I mean, we were ahead of the market yesterday. Like, I feel like we were ahead of everyone yesterday. And we hit that 4-year, we hit the 1-year at the inversion. I'm sorry, we hit the 4% on the 10-year. I mean, a lot of great things as far as what's happening. And the thing is we want the Federal Reserve to cause this pain because what do we don't want that we probably have a little bit of right now. Stagflation. Essentially, the economy is slowing down, but the inflation is still like awful. I don't care what people tell me. They're like the easy part of conquering inflation and getting it down to like 4%. That easy part's done. Now it's like the painful, hard part. Like this is the time where things are going to really get bad. They have to. And that's what, again, the inversion is showing us. But anyways, you guys, so unemployment, okay? Unemployment came out today. And remember, Jerome Powell, pretty much the board has been telling us they need the labor market's too hot, right? They need unemployment to go up, right? And remember the White House last year changed the definition of recession because of unemployment. So unemployment is important, right? I mean, it's important. Now, I understand they calculate it using crazy figures. It's part-time jobs and seasonal, but nevertheless, if someone can go out and get a job after they just got fired and there's 2 jobs waiting for them, that's not doing much. You know what I'm saying? So here's the thing, you guys. Unemployment came out today, and I just want to remind you, when we started quantitative tightening, okay, this was in March. This was March of 2022. So it has been, 15 months. So we started at 3.6, okay, at quantitative tightening. Let's see how well the Federal Reserve has been doing, okay? It updated, as you guys can see here, at 7:45 a.m. in the morning, and unemployment, you guys, okay, 3.6%. Unemployment went down, okay, but that's not necessarily why the 10-year is doing what it's doing. But you guys, how is this possible? We finally hit like 3.7. We're like, oh my God, we hit 3.7. Unemployment's going up, and then, oh, just kidding. The economy is incredibly hot. I guess inflation isn't runaway. I mean, I'm sorry. I guess inflation isn't transitory. I guess interest rates should have stayed high. Like all of us that have pretty much been watching my channel have wanted. Remember how much we were gunning for the 4% on that 10-year, you guys? So again, this is an indication right here that the Federal Reserve needs to do more tightening, right? Or at the very least, we need to stay where we're at right now. Like when we're in that 4% range and that 7% range of mortgage rates, you guys, as long as we're staying here and, things will change. At least it appears that way so far. And really, when I say change, break, right? We need things to break. If things don't break, stagflation for the most part, right? But again, what I'm trying to tell you guys right now is thank God. And I have been, thank God, because I'm looking at the actions, right? When we get good news right now, we are being punished more and the market is starting to wake up. In fact, the market is starting to price in now that second rate increase. A lot of stuff going on right now. You guys are right in the front of a recession. It hasn't quite transitioned into a recession. We still have that, that inversion. But let's start now. I'm going to play you guys a video basically from we're going to go on our talking suit videos now, you guys. I'm going to make my first timestamp. And he's going to go into basically what happened today. It's from this morning. It's basically going to go in, like I said, to the payrolls. Basically, the job numbers came in a little bit less than expected, but the problem is wage growth. Okay, that's a huge issue and something that the Federal Reserve has been like watching a lot. And what I mean is like wage growth, like people can't make too much money. Like they're not as concerned necessarily about the amount of jobs so long as there's not like this wage price spiral, right? The thing is, that was over expectations. They were expecting 0.3% growth in wages. Annualized, it would be more, obviously. We're talking month over month. And it came in at 0.4. So it came in, 25% higher. I know we're just talking about decimal points, but it's still 25% higher. That is a bad thing. More than likely, we're going to get punished for that, you guys. So let me play this first video. I hope you guys enjoy it. Share with me your opinions and comments. Pretty wild stuff going on. Let's go now.
Or not, and it was
Let me know if the volume's okay, please.
209,000 on the non-farm payrolls for the month of June. 209,000. That is the lightest level, and I have to go on the way back quite a ways. That's the lightest level since December of 2020 when it was minus 268,000. If we look at manufacturing payrolls, they were up 7,000. The unemployment rate dropped from 3.7, and we all know that was the highest since Feb of 22. That was last month, to 3.6. So it moderated, but it's definitely still above the 3.4 that we had in April. And of course, we understand that the unemployment rate is something that the Fed's going to pay close attention to. Average hourly earnings up 0.4%. Hotter than expected, matches April. You have to go all the way back to July to see it up more when it was up 0.5. That was July of last year. And if you look at average hourly earnings year over year, they were up a whopping 4.4%. This is the new metric against inflation for many. It's the wage component, up 4.4%. It equals April. You have to go to February of this year to see it higher at 4.7. So even though it's come down a bit, it was 5% in November of last year, it is still definitely above the last several months, which was 4.3, 4.4, and 4.3, as you see. So we're hovering at that zone. And if we look at hours worked, 34.4, a tenth hotter than both what we were looking for and what was in the rearview mirror. Labor force participation rate, 62.6. It remains exactly on top of last month, and 62.6 is 1, 2, 3, fourth month in a row. And finally, the underemployment rate, known as U6, 6.9%. It pops 0.2, 6.9%. You have to go all the way back to August of last year to find a higher number at 7%. Interest rates have dropped. Matter of fact, prior to the number, we were hovering in a 2-year around 5%. Now it's at 4.
And real quick, this is what I mean, guys. You can see, because this video was this morning, you see how that 10-year right here, initially, well, it was up and then it dropped down. Look at it, it dropped 2 basis points. So it dropped like rapidly when that came out. And then people are like, wait a minute, is this a potential wage price spiral? Or, potentially, and then it reversed. Just wanted to point that out real quick.
492. And if we look at the 10-year, it was hovering around 406. It's now hovering at 4%. And we continue, of course, to monitor the equity markets. Usually when interest rates go down, the equity markets go up, and they did pop a little bit, but they're kind of right back to where they were. We need to continue to monitor. Equities have a lot on their plate. And just to summarize some things very, very quickly here, gilt yields, the 10-year gilt in the UK is up nearly 30 basis points this week to the highest level since '08. Bond yields are up 24 basis points this week, a 4-month high. Our 10-year yesterday closed at an 8.5-month high. But here's the rub. You know, that 2-year note yield that reached up towards 5.11 yesterday, it failed to close above its March high yield close. It was March 8th, I believe, at 5.07%. As a technician, if we fail to close above that after trading intraday through it, especially on Friday, a weekly close, it's going to start to look like a double top. Is that horribly bearish? No, but it's something to pay close attention to because many believe we're going to start to see steepening, not necessarily driven by the short end, but maybe driven by long-dated treasuries, which may get stickier as we start to see the Fed get close to being done. And that is the dynamic, because if you look at 2s to 10s at minus 90, it is definitely the flattest in what, probably about 4 weeks, almost a month.
I got to pull up the 2 and the 10. I don't have the 2 and the 10 up right now. I have the 3-month, y'all, because the 3-month is basically 100%. Look at that light in the background. Why is it flickering like that? Basically, the 2 and the 10. I'm sorry. I pulled up the 3-month and the 10 because it's 100%. It's been 100% accurate at calling a recession. And again, you guys, I do want to go. I'm going to pull up the 2 and the 10 real quick. Okay, I do want to go over the inversion, reversing, obviously, but it's really, really amazing, you guys, because our economy is incredibly hot right now. I mean, these interest rate hikes and this inversion and all this type of stuff seems to not be doing enough, at least in the time frame that we've been doing quantitative tightening. I just find that so remarkable. But again, here, let me just pull this up, guys. I wasn't going to do this part of the video, but since he was talking about the 2 and the 10, here's the 2 and the 10 right here. Now, let me go in a 10-year. Actually, let me max this out. So here's the 2 and the 10 inversion. We talk about this a lot because this is an economic indicator of a recession. And normally the 2 and the 10 inversion does signal an incoming recession. Not always. There have been a couple of times where it has inaccurately called a recession, but predominantly is called recession. Now, I do want to point out, if you guys, and we'll go over this here in a minute on the other chart, but the yield curve has to invert the other way. So if you guys really pay attention here, like it inverts, so it goes under the black line, but before we enter a recession, the yield curve reinverts and then recession. Do you guys see that? So it inverts and then it reinverts and then recession. Every single time it reinverts. So the fact that we don't even, I don't see any trend that is showing us that we're on the way to reinvert, which again, what this is telling us is this, you guys, let me pull this back up here. Our economy there's still money in the economy. Unfortunately, we need to spend more time in this situation. The longer that we stay at this tightening levels, the better it will be for us. The more likely it is that we can get through this. Now, here's one of the and also obviously we're in stagflation, but here's one of the biggest concerns about what's going on right now. And everyone, doesn't matter what side of the coin you're on, should be a little bit concerned about this. The biggest concern, what's going on right now, because we know this is federally induced, both the recession and the inflation. If they lower rates and reinvert too soon, if they reinvert too soon and they lower rates too soon, that could potentially add more inflation, get things worse, and then we have a second round of quantitative tightening. That would be super bad. But that's really my biggest concerns. Probably you guys share that with me. Let's go on to the next video right here. Decent video. This is going to go basically on the market is starting, not yet. Okay, it's not 100% yet. Starting to price in that second rate hike, and that would be in November. So we'll go into that in a minute here, but they're starting to wake up. Take a listen, guys.
With Matthew Dezak, head of fixed income strategy for the chief investment officer at Merrill and Bank of America Private Bank. Matt, I was actually talking about some of your thoughts earlier. If you look at where core inflation is, do we have rates about where they need to be right now, within 50 basis points or so?
I think it's a good call, Joe. I think we're definitely in that range of where we need to be. Obviously, monetary policy acts with a lag. So our belief is there's probably 2 more hikes from here, but it takes a while, 18 months or so, for that 5% jump in rates to actually work its way through the economy. So whether it's 2 from here, whether it's 1, whether it's 3, that's kind of around the margins. We do believe that we're very, very close to the end of the rate hike cycle here. That's what the yield curve is telling you. That's what leading economic indicators are telling you. That's what money supply growth is telling you. It's all a very consistent story.
I think you pointed out that the inversion, when did the inversion hit? About November, wasn't it? And how long does it take before we find out what the inversion is telling us?
So, we've seen the curve, different parts of the curve invert at different times. If we want to just focus on the Fed funds to 10-year curve, that's kind of the best indicator. For more than 60 years now, it's never inverted without a recession happening, and a recession hasn't happened without it's inverted. So it's a very good indicator. It inverted first time back in November 2022. And then if you look back at the last 7 recessions, it takes anywhere between 9 and 18 months for the recession to hit. So if based on that time frame, that means the recession is either hitting the Q3 this year to sort of QT next year. And that's right where our range is. Our chief economist, Michael Gapin, believes the recession starts in the first quarter of next year. And so that would be right in the historical range. That would be right down the middle of the fairway of when you expect the recession to occur, just based on the last 7 recessions back to 1970. So we do believe in the yield curve. We do believe it's a great predictor and still a harbinger that the Fed is doing what it needs to do. It will get what it's looking for eventually. Slower economy, slower economic growth, slower wage growth and employment, and bring inflation back down, not to target, but close to the target.
Michael Gapin comes on. He's a very tall man. I think he can. I mean,
we're both very tall men.
He can look out like over and see things. He's someone that you should probably listen to. So what's going on with ADP? What's it mean about today? And let's say that this does confirm those ADP numbers. That doesn't sound like what you just described at all. What's taken so long for things to bite? Is this a head fake, or are there underlying things that we can't really see that play into what you're saying? Because it just seems like, like we're still running really hot, at least in the labor market.
I absolutely agree. Definitely a lot of folks have been surprised at the resilience in the markets, particularly the labor markets. We think it's a not perfectly simple story, but a relatively simple story. Again, talking to Michael Gapin, my colleague and friend on the Bank of America research side, estimates, and it's hard to get this exactly right, but his estimate is there's still another 10 months of excess savings from all the payments the government put into the market, all the stimulus payments made during COVID. And that's really what we're seeing here. We're seeing continued resilience because we have not seen a government spending program of this magnitude relative to GDP since World War II. This was a wartime level of fiscal spending, which in World War II was also financed by the Fed. And shock, what happened? Massive government spending, financed directly by the Fed, double-digit inflation. And we're seeing a replay of that now. So what we're seeing in the resilience here is just that. The amount of stimulus, the amount of payments from the market, there's still a lot of excess savings here. But again, inflation is a monster we know how to deal with. Tighten policy, keep it tight. The Fed's doing a much better job of talking hawkish, not talking dovish, and catching up. So continue doing that. Keep rates where they are. Move them a little bit higher. They'll eventually get what they're looking for, but it's going to take another 6 to 9 months.
Okay, you guys heard it. So a lot of good points right there. Let me know if you guys agree. I mean, he touched into, and I've been talking about it a lot. Some people don't agree with me, but excess savings, the money printing, right? I mean, come on. So the good news is it's being burned, right? But there's a lot of it. And that's why it's taking some time. And that's why it appears like stagflationary trends like that. But I really love that video. It will be linked in here if you guys want to come back to look at it. Now, I'm going to go over 2 comments real quick. I saw some really good comments that I want to go over with you guys. But before I do that, let me go to CMA Fed Watch, and let's see if we have any movement here. So this is CMA Fed Watch. Now, this is the market anticipating what the Federal Reserve is going to do next after meeting when it pertains to raising or decreasing the federal fund or keeping it the same. But it's the federal funds rate. Now, July 26th, this has gone up. Let me refresh it because I haven't refreshed it since the job numbers came out. All right, so it's basically the same. So we're sitting at a 92.4% of the market is saying rate hike in July. We can pretty much safely assume that there's going to be an additional rate hike the next meeting, okay, in July. So now the interesting thing is look at the movement on the other months. There's been a lot of movement. Now that the market's kind of processed yesterday, as far as those job numbers, you guys can see still pretty much the same as far as September. The market basically thinks they're going to go hike, skip. Okay, so here's the skip part right here. This is September, only 22.2%. But look at how much it goes up in November. It goes from 22.2% all the way up now. Okay, so it's a little bit lower than I last looked, all the way up to 35%. You guys, yesterday, like right outside of those job numbers, this was over 40%. So that's why I was like, dang, finally the market is pricing in that second rate hike, but it has gone down almost 10 basis points, which is really surprising. Let's look at December. December is at 30, so still 30. I don't see any, and this is all 25 basis point hikes. Really, the market is not anticipating 50 basis point hikes, so very, very interesting. Now, a couple questions, you guys, or remarks rather, that I thought was good for us to have a brief conversation about before going into the next video. Let me set up the next video. And the next video is going to be about average interest rates. Okay, so this is a good, here's what, Ill Bill, have you guys seen Kill Bill? Great movie. Renting is greater than owning in our situation. Okay. First of all, the first part of that comment, we're in a rare situation where most places, including my own local housing market, is way more expensive to own than to rent. If it was cheaper for me to own right now than it is to rent, I'd probably buy it because I don't like to rent right now. But in my market, because I did a cost analysis on the house I wanted to rent versus own, it's $1,600 difference a month. Just saying. Now, he's going, I would rather wait till seasonality takes effect. Just worried that others are waiting on the sidelines with low inventory. This will just be an unending issue. So let's talk about that. There are people on the sideline. And here's what I want to say. The longer that we're in this situation, the less likely those people will still have excess savings and the same amount of purchasing power. Again, the longer we go through this, the more that pool of qualified buyers is going to dwindle. And don't forget this, guys, there has always been, from the dawn of history, an abundance of demand on the sideline. Pretty much every single person in America, not everyone, but pretty much every single person in America that doesn't own a house wants to own a house. So on one hand, it's always been there, but on the other hand, there's also something that we want to consider, that there is people on the sidelines. So what do we do right now? Are we lazy? Do we just listen to YouTube? Do we let other people do the thinking for us? No, we do our own thinking. If we're on the sideline, we increase our purchasing power, credit, income, assets. So don't forget that, all right? And the good thing, I know Vital's not feeling it because this market's messed up. Let me see this question. The number of people okay, so same thing. The number of people waiting on the sidelines is one of the reasons the house market might crash. People will buy at the slightest drop in prices. The thing is, it's like, I've had the slightest drop in prices in my market, and I'm not buying because I need a drastic drop in prices. So I understand people are getting finicky right now. Sorry about my focus, but I really just want to remind, excuse me, everyone that this is the busy time of year, okay? And it looks scary because the inflation appears to be the same, but I have to keep reminding you guys, and really this is, other than the yield curve inversion, we already had price decline. So the housing market crash already showed itself to us. And it was stuffed back in the box, okay? Housing market started to crash in July of last year, some metro areas exceeding 15%, which I was bold enough to give my definition of a crash, unlike some of these other nerds out there. It's not going to crash, but like, what's your definition of a crash? So it's already reared its head up, but it was forced back into that box, quantitative easing, call it excess savings, seasonality, labor market, whatever it is. It got pushed back in the box. And the thing is, guys, it's going to rear its head out again because it's not grounded in what? Fundamentals. If it was grounded in fundamentals, the housing market would be okay. And again, thank goodness we also have a Federal Reserve that is punishing us and understands that, hey, there is inflation in the housing market and something needs to be done, because right now what they're doing isn't working. It's not working in the housing market. We needed rates to stay where they're at right now, but they didn't. And again, And I'll argue also what we really needed is like no more QE, please, no more QE. But the QE is just so crazy. So we're going to go into the next part, you guys. We're going to go and talk about interest rates right now. So this next video is going to be on how the average interest rates jumped yesterday to 7.22%. And maybe you guys remember, do you guys remember me saying what I think that interest rates would be going into this weekend? You guys remember my live yesterday? I said 7.25. You guys, it almost hit 7.25. So I still think 7.25. Let's take a listen to the video. If you guys can, please. Johnny, I see you. Love you, Johnny. Let me know that the audio is good, okay, guys? So we'll play this right now. It's only a minute long, and then we'll go into the interest rates.
Mortgage rates are shooting higher. Diana Olick is in D.C., and she has the details. Hey, Diana.
Hey, Eamon. Yeah, the average rate on the 30-year fix jumped 14 basis points today to 7.22%. Thanks to that much stronger than expected ADP jobs report. That's the highest rate since last November. Rates had already begun rising last week, crossing over that critical 7% line, and that had a direct effect on mortgage demand. Applications for a mortgage to purchase a home, which had been rising for 3 straight weeks, dropped 5% for the week and were 22% lower than the same week 1 year ago. Interesting, though, the average loan size for a purchase application dropped to its lowest level since January of this year, and that was likely driven by a drop in home buying in some of the higher price markets and then more activity on the lower end. Now, applications to refinance a home loan fell 4% for the week and were 30% lower than the same week a year ago. Earlier today on Squawk Box, the CEO of Compass Real Estate, Robert Refkin, said 7% is now the new normal and people are accepting it. Now, that remains to be seen, especially given that home prices are heating up again. Tomorrow's Labor Department jobs report could also impact rates, but it may, of course, have been upstaged by the news today. Eamon.
Okay, guys, so that is a video on the interest rates. Let's go and see what the interest rates are real quick. Boom, 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 boom. Here we go. So here's where we were at. Remember yesterday what I thought we would be at? Here we go right here. All right, so you guys see that? 7.22%. Insane. You guys, this is what I'm saying. We should never have, like, comment below. Let me know if you agree. We should, in my opinion, if we would have stayed where we were at, which again, 7.22, over 4% on the 10-year, we hit that, I think around October, was it, of 2022? If we would have stayed here, I think that we would have had like less like to go, right? I think that prices would have stayed down, at the very worst plateaued, but we didn't stay here. Why on earth did we not stay tightened up during spring buying season? The time where we needed it the most, things got looser. What happened? You guys remember what happened? Quantitative easing, the bank runs. I really feel like the bank runs really messed us up. But anyways, you guys, we're sitting at 7.22%. Let me refresh this, see if it's updated yet. It has not updated yet. This will update. Let's take a look at the 10-year, see where we're at. 10-year sitting at 0.1% up, which probably means, you guys, we're going to roll into the weekend about where I thought, which is about I'm still going to say 7.25. I think once this updates, it's going to be around 7.25. I am thinking it's going to be higher. So I don't think that's going to go down. I think it's going to go higher. And remember, you guys, if you have like any challenging situation, your rate will probably be much higher. So again, while we're on the sidelines, if we don't have absolutely perfect credit, take this as an opportunity to like do some homework. And the thing is we should be proud of ourselves. And I know I complain a lot, and I'm sorry, I shouldn't do that. I shouldn't vent. Because you guys know I've been frustrated. I'm renting myself. But like when I stop and I think about really what I'm doing here and how like so much of society and our peers are like trying to shame us and like try to like force us to spend our money. Is that the trolling? Like, do these trolls want, I don't get it. But you guys, like when I stop and think, like, I'm proud of myself because I didn't fall, at the very least, even if the housing market doesn't crash the way I want it to, at least I followed my goals. At least I was cautious and I self-sacrificed to achieve something. And anyone that's doing the same thing, that's on the sideline, I really believe we need to be proud of ourselves. Because it would be easy for us to just get off the sidelines and go by. Now, I'm not saying if you did get off the sidelines to go by, you're a bad person. I'm not saying that at all. But I do believe the longer that we wait, the easier it will be for us to find a great deal on a house that we love. And it is what it is, you guys. It's just really hard to find that house that we love right now. But if we can find it, and it's a great deal, we may need to go after it. Now, the next thing is we're going to go into a panel that's going to talk about the interest rates. And then I'm going to go over affordability with you guys. But this panel is basically going to be talking about rates and basically how 7% are the new normal, or at least they should be the new normal. Let me make my timestamp real quick here. And if you guys can, please let me know the audio is good.
On the current state of housing, it seems like there's a bunch of different measures going on, but you still hear anecdotally people are putting bids on houses that aren't even for sale.
Yeah, so earlier this year, I shared that I believed 6% mortgage rates were accepted as the new normal. I think now we're in an environment where 7% mortgage rates are now the new normal, and people are accepting it. The data points I'd use are in the last month, 3 of the 4 weeks on increase in purchase mortgage activity. This week was down 5%, but that's not much, and that's also what you would expect at this time in the spring market. Also, every month this year, the price of homes were higher than the month before.
What about the housing supply? I mean, how do we ever get over the shortage that we're seeing here? Is there really a long-term solution?
Well, the Fed can help if they bring mortgage rates back down.
Hey, you guys,
if they bring mortgage rates back down to a place where they're around 5%, I think we'll see a huge unlock of inventory.
Oh, wow.
But until that time, there's a little bit of a silver lining in housing starts. Last month, we saw 1.6 million housing starts, the greatest numbers since 2016. Also, a third of the jumbo mortgages in the pandemic period were ARMs, and the majority of them were below 7-year ARMs. So the value of that financial asset is going to decrease every year. If it was a 5-year ARM in 2020, you have about a year and a half left.
Wow.
When you say that 7% mortgage rates are now being accepted, it means by accepting it, if home prices aren't going down, you're paying a greater share of wallet of what you earn for housing, which at some point has to change the rent versus buy equation, doesn't it? Would you have more rental supply coming on?
Yeah, so we're seeing housing deflation on price over a year-over-year basis on rentals by 0.5%. And so I think the Fed's done their job there. On sales, although it's been up on price every month this year, it's about 3% less than the prior year. And so I think we're seeing a normalization at this point between rent versus buy. The issue, again, is inventory, and we need to see an unlock in order to create more balance. But the issue that the Fed has, in order to bring down price, they're trying to prices in general. They're bringing up rates. But as you bring up rates, mortgage rates go up. And as mortgage rates go up, more inventory is unlocked. So they're in a kind of catch-22 where they're not able to actually bring down the value of these homes.
So what are you seeing then from sellers that may have a home that could be in high demand? But if they sell it, then of course they have to find a new place to live. They may then have to pay a higher rate than they're currently selling. I mean, how are they deciding that calculus if they want to unlock the value of the home, but then obviously they're going to have to pay more to live somewhere else?
So a few things. One, we're seeing more people buy without mortgages than the past. So historically, it's been around 25% of buyers were all cash buyers. Now it's almost 40%. This is a higher than the number I've ever seen.
Well, the Manhattan number is 65 in the last 3 months. Cash. It's incredible.
Yeah. So if you have cash, that's a way to get through this. But on the other hand, we're seeing are more buyers that have to buy because you have to move. There are life events. People get married. They have kids. They have a new job. They have to return to office. They move to a Zoom market. What we're seeing them do is that they're buying a new home, but instead of selling their existing home, they're renting it out so they can have the financial arbitrage between low mortgage rates and high rents.
Wow. Since you mentioned it, with changes in work and the way that we live our lives, what's happening in some of these Zoom boom towns?
So the Zoom markets, there's not a Zoom market that I know that's doing well, right? And so you have Boise, Idaho, you have Salt Lake City. And so the demand that went there is coming back because CEOs across the country are expecting people to come back to office at different rates. The opportunity that I would see is in downtown San Francisco.
Oof.
And here's why. You just saw in Seattle, which is downtown, very similar to San Francisco, that there became a moderately robust market after Amazon required people to come back to office. CEOs in downtown San Francisco will expect people to come back at some point. And when that happens, the downtown market, I believe, will surge in prices with it.
There's a lot that has to happen, though, in that San Francisco market to clean that up. Thank you very much for joining us, Robert. Very fascinating conversation.
Very interesting stuff here, guys. So I don't know if you're caught up, but we're starting to see a lot more arguments now where people are saying, like, we're going to get a surge of inventory when the rates go down. And I actually never even comprehended that possibility until a couple weeks ago I sent out a poll yesterday on my channel, and I think we got like 3,000 votes. And 30% of the people that voted thought that it would actually bring, with the rates going down, would bring back more sellers versus more buyers. It's really, if we think about that possibility, that's really, really intriguing. So will if rates go to 5%, residential mortgage rates, if residential mortgage rates go to 5%, obviously that's going to help with the gridlock for new listings. It should also help the people that were priced out, that are buyers. So very interesting. I mean, seriously, what if we get a skyrocketing amount of inventory when the rates go down? That would be freaking crazy, right? Which is, again, that's why it's so important for you guys to like be working on your purchasing power, because I guarantee you guys there's going to be some institutional investors that are ready on the sideline. Now, I believe that a lot of those institutional investors are going to have their hands full in commercial real estate where they already are seeing bargains and like pennies on the dollar. So, there's only so much money, but we'll see here. Now, what I wanted to show you guys is like this whole new normal, right? Oh, it's the new normal. I mean, look at this. I'm not buying it. So, has the market gotten used to 7% interest rates? No, there's just people that still need to buy. The market back, what was it, 1980? Around 1980, I can't remember the date, but the rates were at 22, 24%, you guys, and people were still buying. Okay, so there's always been the need for people to buy. But what I want to say is like, this is so far from like what it should be for the new normal. And we can see that with the home buying payments right here. And this is not even updated. This is a home buying payment on average at 6.71. You guys, we're at 7.2. We're a half a point higher. But even at the lower interest rate, you can see average person's mortgage payment, $2,600. Just 2 years ago, the average mortgage payment was about $1,600. Just 2 years ago, you guys. So in 2 years, the average mortgage payment has gone up over $1,000. Okay. To me, again, that's not sustainable. That's why I'm saying, like, as long as we stay where we're at right now, this hot economy, it's not sustainable. And I'm saying that because the consumers are falling apart. I know there's excess savings. I know the labor market is hot, but we are getting our butts whipped. And we're paying for other people's projects. We're paying for our politicians. I'm sick of it. Consumers are getting beat up right now. This whole economy and the propping up is based on our backs. It's being put on our backs. Now, I've had to sacrifice to stay ahead of it. I hope you guys are as well, but not for a single moment do I think that this is the new normal. I think we're going through a transition period right now of quantitative tightening. We're trying to prevent stagflation. Meanwhile, we have a Federal Reserve that's trying to create a soft landing. It appears that this goal for the soft landing is just kicking the can down the road. I mean, you guys, something's going to break. If we stay where we're at right now, again, 4%, 10 years, 7% mortgage rates, something will break. We already know this because something's already broken. What's going to break next? Okay, what's going to break? There's so many catalysts right now, but let's go into our next video, y'all. Okay, this next one, my gosh, this next one really gets me triggered. Oh, people don't like when I say that. I'm sorry, I shouldn't have used that word. People think the word triggered is a little kid word, so I'm sorry. But I'm surrounded by little kids all day, you guys. I have children all over the place. So we're going to go into this next part. Now, this is very interesting. This next video is going to go into the talking suits talking about credit tightening. So just for a moment here, I know I'm beating a dead horse here, but we need to be able to get through that first couple hits of the recession. Again, job loss, and another one, credit tightening. How do you get through those things? Well, you got to be an asset to your employer. You got to have maybe another job lined up on your back, on the back burner. But the thing is, guys, our credit, we need to be increasing our credit because another hit, maybe it's going to be a lot harder to get loans. Okay. We haven't seen that yet. Okay. In residential mortgage, you could argue there have been maybe a little bit of tightening in residential mortgages, but for the sake of argument, I'm just going to straight up say, you guys, there has been absolutely no freaking credit tightening in residential mortgages, which is where we want the tightening. So if they would have just let the banks fail naturally, we would have had credit tightening. We would have, but they reset the risks because they bailed out these banks, toxic asset exchange. But let's listen to the credit tightening video, because what's possible, you guys, is that we enter recession or job loss and credit tightening simultaneously, which again means that if we are on the sidelines, do not get lazy. Make sure, increase your purchasing power, because it may be twice as hard to get a home and maybe no competition. Think about it. Prepare for the worst. You can hope for the best, but don't act on the best. Hope, right? Prepare for the worst. We're going to listen to this now, you guys. Please let me know that the audio is good. Sorry for that morning rant. I'm just happy it's Friday. So happy it's Friday. You guys enjoy the video.
Heard the litany of hot seeming numbers in the latest batch. We've gotten the relatively hawkish Fed speak. Are we in a reacceleration of this economy, or is this just a passing phase?
So I think it's really hard to say because there's a lot of conflicting signals coming out of the economy right now. And some of those conflicting signals were actually mentioned yesterday in the minutes to the FOMC meeting. So I think we'll have a better sense tomorrow. So it'll be easier to answer that question tomorrow than today. But right now, it does look like the labor market, the slowing that may be occurring in the labor market is definitely very gradual. But we'll have a better sense tomorrow. Okay. And then in terms of the way the rates market is repricing Fed expectations and also how long we're going to stay there, it seems as if that's been one of the notable shifts recently. Yeah, I think the Fed has been pretty successful in, disabusing the market of the notion that they're going to be cutting rates, shortly after reaching the terminal rate. So I do think that would be, considered a success here in their communication policy. Of course, they've gotten a nice assist from the data, which has also kind of shaken off the idea that the economy would quickly buckle under the impact of the cumulative rate hikes. But I think July is obviously looking pretty much like a lock unless we get a disaster tomorrow, and then I think the path after that gets a little more interesting given the data we've seen. Are we searching for that pain point for the economy at this point? I mean, it seems as if growth has held intact. I mean, not at gangbusters levels, but real growth that maybe in the 2% range at this point. Structurally, labor market seems like it doesn't really want to soften up too much in the short term. Again, you have to weigh that against these sort of long lead time forward indicators of recession risk, like the leading economic indicators, like the yield curve. What are we placing most weight on here? So I think we are kind of feeling our way to that pain point because, I think Chair Powell doesn't trust forecasting a whole lot, economic forecasting. And so I think he's willing to continue to kind of dribble out rate hikes until you actually start to see things buckle rather than just forecasting things to buckle. And I think most notably that has to come in the labor market. And we're really not seeing signs of that. We had a little bit of improvement in lower job openings today, but then you also had a pretty decent increase in quits, which is a sign of confidence in the labor market. So until you start to see those go in the right direction more convincingly, I think Chair Powell is going to be inclined to, continue to dish out the rate hikes until he sees some cracking there.
Mike, ahead of the bank earnings that we're going to be getting here fairly soon here, Lori Logan basically saying she doesn't believe that the banking stress that we'd seen earlier in the year is having an outsized impact on credit availability. Do you agree with that? And how closely is the Fed watching and or worried about that as we could be getting a slew of more information here? Yeah, I guess it depends on how you define outsized impact. It's certainly nothing like, 2008, of course. But I do think most indicators suggest that bank credit is getting tighter, particularly for smaller businesses. And you see that also in the weekly C&I lending, which has generally been trending lower. So it is a headwind. I don't think it's, an acute headwind, but it is something that, and I think you saw this in the Fed staff forecast yesterday when they were talking about their recession forecast. It was pretty importantly informed by what we're seeing in banking development. So it is going to be something they're going to be watching very carefully because, if they break it, they own it. They're the regulator and supervisor of the banking system. So I think they want to see, tightening being transmitted through the banks. But I don't think they want to get, brought before Congress to answer more questions about more bank failures.
Hey, Mike, on the list of things that people, or at least the bulls, were hoping for, goods deflation, but also now shelter graduating into a period where rents would begin to ease. We are seeing some alternative data suggesting it, but I wonder if you believe it right now. So in the official BLS measures in the CPI report, you've been seeing some rolling over of those measures of inflation since about March, not in a dramatic way. But I agree with your point that, in some of these alternative measures like Zillow and so forth, you had seen, pretty sharp deceleration late last year. And, I think there was some expectation would follow through this year. And instead, you really seen kind of
more stabilization. So that process may take a little bit longer than people were thinking, 6 months ago. On the other hand, it is, I think it's a positive thing that last week we saw multifamily housing starts at a, I forget, 30-year high or something like that. So you are seeing the appropriate supply response. It just takes at least 2 years or about 2 years for that to get online.
Yeah, a lot of things taking longer than we anticipated in this cycle. We'll see how it plays into tomorrow's numbers. Mike, thanks very much.
Good to see you.
Mike Froley of JP Morgan.
All right, guys. So it's a little bit of that, a little bit of that info. Let me know what you think of that. I mean, the reality is, guys, is really there's the cat's out of the bag, right? The Federal Reserve needs to do more tightening. We see that. We see that with the numbers in the economy. We see that with the quantitative easing that they're doing. I mean, there's nowhere left for the Fed to go. We're really literally up against, they're cornered. They're basically cornered right now. They're in a corner. They're boxed into a corner. They got no choice but to bring the pain back. And again, if they would have just not softened their tightening the beginning of this year, I think that we would be where a lot closer than to where we would need to be to have this market reset. Because let's not forget, you guys, the consumers are paying for all of this. The little people are paying for all of this. So it is what it is. I'm going to go into the yield inversions, but real quick, let me bring up some comments that had some pretty good points. But we're going to end with the inversions, and it's going to be really good. So you guys stick around for the inversions. But real quick, Danny, I just wanted to say thank you, brother. You didn't have to do that. Hope everything's okay. Let me know what's going on with Artavia, not Artavia, Artavia. Let me know what you decided to do, Danny. But thank you, brother. You didn't have to do that. Thank you for the super chat, my friend. Now, real quick, you guys, 2 comments that I wanted to throw up here. One was another one from House Hacker. So House Hacker, good point. If the rates drop to an average of 4%, he's basically saying with his high credit score, he can easily cash out on one of his houses and buy 2 houses in Vegas. And the reason I brought this up is not just yeah, let's go House Hacker. Yeah, buy all our houses from us and make a profit. I'm not saying that. But what I'm saying is let's not forget, this is federally induced. The Federal Reserve is in control, right? We're in this situation because of the Federal Reserve. So what I'm saying is, if the Federal Reserve drops interest rates too quickly and the inversions reinvert, odds are we're going to have a second round of really horrible runaway inflation, and we'll have to go through this all over again. And that's just the reality. We need to. So what time has told us is we need to stay here. Okay. Anytime we go down from what we've seen so far, under 4%, under 7% in the mortgages, the market rebounds. Okay. Now I know it's a little bit hard to know because the quantitative easing that happened, but nevertheless, this is where we need to stay because anything lower than when we're at least so far, it's just not enough. Okay. There's too much money that was pumped into the economy. So thank you for that comment, House Hacker. One more from, I wanted to, another one from Living in Omaha. Living in Omaha is also a realtor. And I really appreciate you commenting, man. I appreciate realtors commenting, even if we don't agree, especially when they're respectful. There's another realtor that said they want more stimulus money to buy a beer. As I was just complimenting realtors. Anyways, this is a good comment. What if, okay, because I've thought about this as well. Okay, I'm not going to act like, and I'm not a conspiracy theorist per se, but I have thought about this. This is his comment. What if it was broken by design and they want people to rent? They went crazy with all of the new building apartments. I mean, tell me what you guys think. Tell me what you guys think. I'm going to just say that I think there's evil people in the world. I think that there are evil people in the world that have their hands in the cookie jars. I don't want to go too much into this, man, because I'm going to scare people. But the thing is I am sure that there are some people that are capitalists that want that. Okay. What we need to hope is our elected officials aren't some of those people. So the question is our elected officials honest enough? Right. And that's a scary answer. That's a scary answer. Anyways, but it is what it is, guys. So now let's go into the inversion. I love this. Okay, this is what I need you guys to pay attention to. I'm basically going to tell you guys what's happening, okay? We're not looking at the 2 and the 10 inversion. We're looking now at the 3-month and the 10-year inversion. The reason why we're looking at the 3-month and the 10-year versus the 2 and the 10 is because this economic indicator of a recession has been correct 100% of the time. This has been correct 100% of the time. So anyway, so when the people say, Travis, your fear, uncertainty, and doubt, or you're just doing this for views and all of these types of things. It's like, I really want to shake my head at these people, because it's like, you guys, I'm basing what I'm saying off of, well, my experience and what happened to me and my caution, but also the historical precedents for what's going on. So when people say, tell me, just buy Travis, it's just going to go up, it's just going to be okay. Again, they ask me to ignore historical precedents for waiting and preparing. So the disconnect is this: people think we're just waiting, that we're just going to sit here and just wait forever. The reality is I'm waiting because I can't wait to spend my money. I want to spend my money on a house, but just not yet. Okay? Because I'm following historical principles. That literally, I can go explain to my 7-year-old daughter right now, and she would understand what I'm saying. So this is important. Okay, because this is the historical precedence right here. Now, again, this is the 3-month and the 10-year. This has inverted. Let me max this out. We know, and unfortunately, this is only going back to the early 80s. I don't know why that is. I thought I could go back to the 70s. It's okay. I want to point out that every single time, every 100% of the time that 3-month, not the 2-year, the 3-month has inverted over 10, we've led to a recession. Look at that. Every single time. 1989, boom, recession, inverted here. Boom, recession, inverted here. Boom, recession. Even in that little tiny recession we had during lockdowns, which kind of like took some of the data trends for a loop, even that recession, look, inverted 100% of the time. But what's really astonishing, you guys, if we look back to 1980, look at the depth of the inversion right now. Look at this depth of inversion. The reason, this is our warning sign. This is our red flag. This is what's saying, like the economic indicator that's saying, everyone be careful. Short-term pain incoming. Be careful. That is it right there, you guys. That is our biggest case for waiting. Well, I'll say that the equity run-up and the unaffordability is just as big as a arguing standpoint, but this is the red flag. Until this, so if people think that I'm wrong, and I haven't made a video, and I will if I am wrong about what I'm saying. I'm not going to say that I'm wrong until this reinverts and we have a period of maybe 6 months. We are still in the middle of all of this, guys. Look at the level of the inversion. And I also want to point out this. We're not in recession. According to the bond yields here, we are not in recession. According to this, we're not in recession because remember this, okay? It has to reinvert first. This is so important you guys understand this. And this is why we got to wait more. We got to wait more because it's not even reinverted. Look, it inverted here, okay? But before the recession, I hope you guys can see those gray lines. I don't know how well you can see that. But before we went into recession, it reinverted. Same thing. Every single recession going back to the 1980s, it has to reinvert. Then shortly after the reinversion, recession. If there's any haters listening, okay? If we reinvert and we have a period of 6 months, okay, and home prices still don't go down and the inflation is still here, I'll say, you know what? I was wrong, okay? Then I'll turn into a conspiracy theorist at that point. And then I'll start being a conspiracy theorist. I'm like, you know what? They said it's up to fail. We're going to be a renter of nations, da-da-da-da-da. But again, if I'm wrong, then this is the first time in history. This will be the first time in history that we make it out, that we have the soft landing where we don't go into a recession. And again, the missing piece of this puzzle, and I hate to say it, you guys, is the unemployment. I know what spiraling out of control unemployment's like because I went through, in my adult life, I went through the great financial collapse. And I was in real estate. I was in mortgage. And I remember what that was like, you guys. I was an incredibly passionate, driven, intelligent professional. But when that great financial collapse hit, and I was in Southern California, we got hit bad. You guys, listen to me. I applied for a job at Walmart. Obviously, I was super depressed. I mean, come on. I lost everything, lost my job. I felt ashamed of myself. And then top the fact that I couldn't even get hired at Walmart because there was just no jobs. So in the snap of a fingers, everything can change just like it always does. And really, you guys, that's going to conclude this video. And really what I want to say is just this final thing. You guys have a great weekend. Be safe out there, but control your emotions. And I'm talking to myself. We need to control our emotions, understand this whole quantitative tightening thing, quantitative easing thing. We're still in this journey. And at the very least, whether you're freaked out or not, I think it may be a good idea to maybe pause our plans to purchase and let the story play out. I just personally, I don't want to jump a gun. I don't want to get trapped renting, you guys. I do not want to get trapped renting, and I do not want you to get trapped renting, because owning is great. I want you to continue searching for a great deal by using the data, working with a realtor, becoming a realtor, but understand what's happening in our market. We're not even close to being done yet. And again, now we're at breaking territory. Now, to the housing market, perfect timing, because, and I'm going to do a video here a little later on the Redfin data that came out. We are right, really literally in just like head up to like, if something doesn't change, we will have year-over-year growth in the housing market. And it is possible that the inflation this year is worse than last year. But the thing is, guys, everything comes to an end, especially when it breaks fundamentals. I will put money down. Oh, well, I can't do that, but I'd put money down and bet you guys that once the pendulum swings the other way of seasonality decline in prices, it's going to be magnified just like last year. Now, if you must buy a house, you're probably going to want to buy a house during that typical seasonal decline, which again is generally in December to February. Anyways, guys, I hope you guys enjoyed this video. I absolutely appreciate you guys. So we got, what's up, Omar? So you got it. Hey, Omar, I just real quick. Hey, I know I offended a lot of agents, especially here in Houston. I am sorry if I offended you. I got so many phone calls. My point with realtors is like this when it comes to commission, because they hate when I talk about commission. Okay, Omar, this is to you and any other realtor that's listening, to clear this up. This was my point about the realtor commission. If, as realtors, and I'm a realtor and I do this myself and I practice what I preach, if we have the ability to help our client get the home of their dream by waiving a portion, I never said all, by waiving a portion of our commission, I think we should do it. That's the point I was trying to make. You may disagree with me, that's all right, but that's all, okay? And I didn't mean to offend like half of Houston by making that video. My gosh, you guys, it was crazy. But anyways, guys, other than that, have a great weekend. Hopefully I'll be able to do a live tomorrow. I'm just not sure. We'll see what happens in the market. I don't want to do any boring lives. And if you're out there investing in real estate, you guys already know I wish you luck, and I hope you win. And happy Friday.